China doesn't warn markets. It acts first. And right now, China is making moves that strongly suggest a coming silver shortage. If this signal is real, industries, investors, and supply chains are about to feel it. And by the time this becomes mainstream news, it will already be too late to react. China has just given a signal that suggests it's preparing for a tighter silver supply. This matters because silver is no longer just a precious metal. It is a critical industrial resource. In this video, I'll break down what China is signaling, why it's happening now, and what it could mean for the silver market, global supply, and investors going forward. To understand why this matters, you first need to understand how China operates in commodity markets. China doesn't speculate the way traders do, it plans. When China begins securing raw materials, it's usually because it sees long-term supply risks that others are ignoring. We've seen this pattern before, for example, in energy markets, where China quietly locked in long-term supply before global shortages became obvious. China moves early, absorbs supply quietly, and lets the consequences show up later in the price. And that brings us to the real question: why silver, and why now? Silver is often treated like just another precious metal. But in reality, silver is a critical industrial input. Unlike gold, silver is consumed. It's used in electronics, solar panels, electric vehicles, medical equipment, and advanced manufacturing. And once silver is used in these processes, much of it is gone permanently. That makes silver fundamentally different from assets that can simply be stored and reused. Take solar energy as an example. Every solar panel requires silver for its conductive properties. As countries push for renewable energy and expand solar capacity, silver demand increases automatically. And unlike consumer demand, this type of demand is policy-driven. Once governments commit, the demand doesn't disappear. Now look at electric vehicles. EVs rely heavily on silver for electrical contacts, power management systems, and onboard electronics. As EV adoption accelerates globally, silver usage scales with it. This isn't a one-time spike, it's a long-term structural trend. We've seen this behavior before. In past commodity cycles, when major economies began quietly securing supply, it often happened before prices reflected the real shortage. The market stayed calm at first. And then, once supply stress became visible, prices adjusted very quickly. What's important is that markets rarely react to early signals. They react when the consequences can no longer be ignored. So, what exactly is China doing right now? Instead of a public announcement, China is moving through the Shanghai Gold Exchange, SGE. Recent data shows they are securing silver for industrial use at a pace we haven't seen in decades. This isn't about speculation, it's about security of supply. And when a country with China's scale acts this way, the message is clear. They are preparing for a future where silver is hard to find. To understand the magnitude of this signal, you have to look at the Shanghai Gold Exchange, SGE. For the past several months, silver in Shanghai has been trading at a massive premium compared to the London and New York spot prices. We are talking about a 10% to 13% gap. Why does this matter? Because in a balanced market, prices are the same everywhere. But right now, China is screaming that it needs physical silver so badly that it's willing to pay $3 to $4 more per ounce than the rest of the world. This isn't just a glitch. It's an arbitrage vacuum. Physical silver is literally being sucked out of Western vaults in London and the COMEX to satisfy Chinese industrial hunger. While Western traders are busy selling paper silver contracts, China is draining the world's physical inventory. The data is undeniable. Registered silver stocks in the SGE have plummeted to multi-year lows. China has moved from being a major exporter of silver to a massive, quiet hoarder. They are prioritizing their solar and semiconductor dominance over global price stability. If the price discovery is happening in New York, but the actual metal is disappearing in Shanghai, which price do you think will be real when the vaults hit zero? The real question now is what this means for global supply, and who feels the pressure first. To find the answer, we have to look at China's industrial backbone: solar energy. China currently controls over 80% of the world's solar panel manufacturing. But there is a massive technological shift happening right now that most people are missing. The industry is moving from older P-type cells to a new generation called TOPCon, tunnel oxide passivated contact. Why does this matter for silver? Because TOPCon cells require significantly more silver to conduct electricity, roughly 30% to 50% more silver per watt than the technology they are replacing. As China scales up its solar exports to meet global climate targets, its demand for silver isn't just growing, it's exploding. In 2023 alone, the solar industry consumed nearly 200 million ounces of silver. That is roughly 20% of the entire global annual supply coming from just one sector. This creates a black hole effect. China cannot afford to stop its factories. If they run out of silver, their industrial dominance collapses. This is why they are paying those 13% premiums in Shanghai. They aren't buying for profit. They are buying for survival. If one single industry is already swallowing 20% of the world's silver, what happens when the rest of the world tries to go green at the same time? The crisis deepens when you look at the supply side. You might think that higher prices would simply lead to more mining, but silver has a unique production trap. Roughly 70% to 80% of all silver produced globally is a byproduct of mining other metals, like copper, lead, and zinc. This means that even if silver prices skyrocket, miners won't necessarily dig more. They only increase production if the demand for copper or zinc goes up. Silver supply is essentially trapped by other industries. Furthermore, we are currently facing a massive structural deficit. According to the Silver Institute, the global silver market has been in a deficit for 3 consecutive years. In 2024, that gap is expected to remain critical as industrial demand outpaces mine output. We are consuming more silver than we are producing, and the world's above-ground stockpiles are being depleted to fill that gap. China knows this. They know that new silver mines take 10 to 15 years to become operational. They know the supply is inelastic. And they know that in a world of shrinking inventories, the one who holds the physical metal holds the global leverage. When the supply cannot grow and the demand cannot stop, the only thing that can break is the price. Are you prepared for that breaking point? This isn't just about solar panels or electric vehicles. This is about leverage. By securing the physical silver market, China is effectively gaining a veto power over the West's green transition. If China controls the metal, they control the technology. If they control the technology, they control the future of energy. But there is an even deeper layer to this move. For decades, the silver price has been dictated by paper trading on the COMEX in New York. By moving the real demand to the Shanghai Gold Exchange, China is challenging the Western monopoly on price discovery. They are moving away from a system based on promises to deliver to a system based on physical possession. As the West continues to struggle with inflation and debt, China's quiet accumulation of hard assets, gold and now silver, signals a shift toward a more commodity-backed economic reality. They aren't just protecting their industries. They are insulating themselves from a potential collapse of the Western financial order. China's signal is no longer a warning, it's an active operation. The divergence between Shanghai and New York, the explosion of TOPCon solar technology, and the shrinking global inventories all point to a single conclusion. The era of cheap, abundant silver is over. The markets may not be screaming yet, but the silence of the vaults is deafening. In a world where physical supply is king, the only question left is, how much of it do you actually own before the exit door closes?